and then we'll go live. Let me make sure. Hello, everybody. Welcome in. This is my first ever interview with Jamie Coutts from Bloomberg. Jamie, how are you today?
Doing really well.
Thanks for joining. And I know you're on the other side of the planet and it's Saturday morning. So again, we are very grateful that you made the time to be here with us. And scheduling with you has been a dream. So thank you so much.
Yeah, absolutely.
There's a lot to discuss. We're going to go in many, many different areas. And for the audience, I don't know if you want to spend 60 seconds letting them know who you are. And you work with Mike McGlone, who everybody knows, and everybody knows Bloomberg. But maybe take a quick intro. And by the way, audience, I have Jamie's Twitter down below in the description, so make sure you follow him. He publishes some really good stuff. So Jamie, over to you. Quick intro to the team.
Yeah, so I work at Bloomberg Intelligence. Mike McGlone, who you've obviously spoken to in the past, is a colleague of mine. He's been covering Bitcoin since really 2018. I moved into the team at the start of 2022. My background is really from equity sales and equity trading. So I worked in Australia, London, and then in Singapore on the sell side, and then at a macro hedge fund for a couple of years. Moved to Bloomberg as their equity specialist. And really over the last sort of 5 years, taking a very keen interest in what was happening within the crypto markets. I was very much part of Bloomberg's product development and some of the new features and functionalities that Bloomberg now has in that space. So I really cover crypto markets specifically or solely, or as Mike covers also the commodities. And I tend to look at the space, with a view to try and build very robust models to try and explain the adoption that's happening in this space. Because a lot of our clients at Bloomberg are institutional. So we're really trying to provide that bridge for the institutions to come into the space and understand the space a lot better.
I love it. A fellow model builder. That's fantastic. It was funny, just while I was waiting, I tweeted something. I was just looking at some charts and I was looking at the S&P 500 and I have this, one of my watch list items of about 5,000 items is the S&P 500 divided by the M2 money supply. We are right back where we were 64.3 years ago. So I don't know if you ever thought that was bizarre, but I always tell people, if you're not beating the market, you're just treading water. Does that analogy make sense to you? And do your clients
totally.
look? Yeah. So
I don't think enough clients really do look at it, to be honest. I mean, you've got to denominate your returns in the money supply, and the money supply takes different shapes and forms. I mean, you look at base money, and that's really your M2. You can also look at it in terms of the funny money, the financial money that the Fed prints in terms of bank reserves. And I've done this analysis. I was speaking in India in October last year and represented to the audience here, and it doesn't really matter which market you're in. If you take the returns of any given asset, whether it's the index, like the Nifty in India or the S&P 500, and you actually denominate those returns in base money or the balance sheet of the central bank, what you've seen is actually really debasement, destruction of returns. And there's very few assets that have actually outperformed that debasement.
Yeah, it's funny you mentioned India. I have been tracking that Big Short case, which has been fascinating to see how, 7 shell companies, 85% held by insiders. It actually reminds me of crypto to a large extent, like not Bitcoin, but a lot of the coins out there. It's just bizarre, the games that are played. So a lot of what this channel is about is really to shed light on truth out there. So let's jump in. I'm going to hit on something which is kind of news over the last, say, 30 hours. It hit, rattled the markets, took crypto down. I was watching Bitcoin. Bitcoin's fallen 7%. Ethereum fell 10%. And some also fallen a lot more. But there's talk, it was originally leaked by Nick Carter, I think about a week ago. And a lot of people kind of took it with a grain of salt. But that guy is special. He's always right. He referred to kind of Operation Choke Point 2.0, the government initiative that sought to cut off undesirable stuff like shadow banks and online gambling and all sorts of weird stuff. And now crypto apparently has fallen into those sites. Have you and your team been tracking that at all? And do you think it's a death knell for crypto or just a black eye? What is your take right now?
Yeah, so we've been tracking it. We have legal and regulatory analysts within the Bloomberg intelligence teams that's constantly writing on what's happening, whether it's the Ripple case or what's happening with Coinbase. So, we've been definitely looking at what's been happening most recently with the SEC decision with Kraken. Now, the view that our team has is basically the Kraken staking situation was a little bit different to Coinbase in that some of the actual returns or the staking rewards that people on their platform were receiving were not as directly tied or tethered to the actual protocol returns. So that sort of differentiates them from Coinbase a little bit. But in terms of what you're talking about and Nick Carter's piece, and I follow Nick as well. He is probably one of the probably the first influencers that I looked at, and he's been fantastic on this space for many years, very, very consistent. Is that there's obviously a very deliberate effort being made by the Biden administration. Now, this really goes up against the other factions that are now present and growing within Congress, which are a little bit friendlier to the crypto industry. You have politicians from Texas talking about Bitcoin mining. You have Congresswomen like Loomis, Gillibrand trying to bring forward proactive regulations or proactive legislation last year or the year before, and that may be tabled again in some form in this new session. So there's really a battle going on, but obviously it's a Biden-led administration, and they do have control of a lot of the apparatuses within the industry. So at the moment, it does appear like this is definitely a negative, but it's not the death knell. What they risk, the US risks by pursuing this kind of policy, this very regressive type approach to a new technology that has a lot of potential, is that it will push it offshore.
Exactly.
There will be other jurisdictions who will pick it up and will run with it, and that sort of game theory is definitely at play.
Yeah, it's funny when I hear some of the politicians, the way they talk. There are parallels with like the Taliban of let's just suppress everything, kill everything, because exactly like you say, it'll push everything to decentralized exchanges offshore and to friendly jurisdictions, and the US will lose that opportunity. What I've also noticed too is there's been a split between left and right. The left is very anti everything except for some things which are bad. And the right are the ones now embracing crypto. And the right used to be the ones against it if you rewind the clock 5 years ago. It's kind of funny the way the tide has turned. Have you seen that happen in other nations around the world or just the US?
Well, there's definitely polarization that's going on. So yes, that's definitely occurring. But there's still some factions within the Democrats that are trying to work with Republicans, or at least a little bit more friendly towards the crypto industry. There does seem to be more proponents on the Republican side in the US currently. So yeah, I would agree with that. But I think it's fascinating. If you look back to when the internet was really coming onto the scene and they were thinking about legislation and Congress was passing bills on the Communications Act in the 1990s. If you actually go back in time and look at what was happening 30 years ago, the way they approached that new technology, i.e. the internet, and the opportunity it presented was very much a gloves off type approach. Mm-hmm. You've got a very different environment. You fast forward 30 years and you're actually seeing a lot of the US administration or the political apparatus sort of trying to protect industry and invested interests a lot more than what they were willing to in, say, the 1990s and even before. So, the contrast here is massive. And this is a real problem, I think, for the US, because it was those innovations that really kept US ahead of the game. The free market approach to innovation and to industry allowed the internet to proliferate and gave the US that the human capital and the technology to really stay ahead of other countries. So I hope that they don't lose that edge.
Yeah, I like that approach. You say hands off, gloves off, I think was the term. And from the late 90s onwards, I was in Silicon Valley, so I saw Sand Hill Road, the impact of the VCs. They're the ones that should really be credited, even though they're very much hated in the crypto world. But they're the ones that gave birth to all of the technology that have made the US a leader. So getting back to a lot of the strange stuff that's happening, if this alleged choke point 2.0 thing is happening, that would make us question everything, like, could SBF at FTX be a plant to bring the whole system down? Bring about the catalyst to help regulators bring about choke point 2.0. Am I reaching here, or is that theoretically even feasible?
Look, I'm not sure. But the one thing is clear is that there are political ties from FTX into the Democrats, and they also donated to the Republicans, but it was a lot more one-sided to that to that side of politics. I don't know. I wouldn't say necessarily that I believe he was a plant, but I think it just speaks to the lack of transparency and the breakdown of the US political system. That on one hand, you have regulators basically not willing to engage the industry and use enforcement over really consultation, and that's really been the approach of the SEC from the very start, and more so since Gensler's taken it, since Gensler came into the role. So approaching it from an enforcement perspective, and the industry's been, on Capitol Hill for many years, asking for clearer rules, better guidelines, engagement. And then on the other hand, you've got donations being taken from, a character like SBF and the firm FTX that's pushing against or trying to influence the type of regulation that gets created to favor really the one area of crypto that is not innovative, and that is the exchanges. The exchanges are an old model, revamped for crypto. They don't do anything. They don't further crypto other than basically provide the on-ramp to it. And what I was able to sort of detect from the bill that SBF was trying to push forward was really, wrapping DeFi, or basically cutting off the innovation within DeFi and putting his exchange really at the forefront of centralized exchanges. So you had these sort of, these two things going on at the same time, and I can't speak to whether it was all planned, but it's just, I think it reflects the current malaise in the US financial system, in the US political system, in the US.
Yeah, and we also know how the traditional, like, Wall Street firms, etc., have deep hooks into a lot of the politicians who actually originally came from Wall Street in the first place. So it's all very incestuous, you could say. Anyway, let's move on. Let's talk about crypto itself, because that's why a lot of people want to hear. And sorry about the long intro, but it's so important. Like, looking at macro, looking at regulation is critical if you are in this space. I know your partner. I was going to jump in and talk about Mike McGlone, your partner in crime. Of course, not in crime, but at Bloomberg and your research organization. He believes Ethereum will outperform Bitcoin. And in the light of recent events, with the hammer falling on staking, does that change that calculus at all for you guys? Or is it still the same?
Yeah, I think we need a little bit more time to look into the, the fallout from what's happened with Kraken and staking in general. I also hold the view that Ethereum could well outperform Bitcoin over the next couple of years, just because of the very elegant dynamics that are at play within its, supply, the emissions, or the deflationary nature of the protocol as activity starts to increase, which is, you've got this very sort of pro-cyclical element. And if you do have continual adoption of the blockchains, and given that Ethereum is, at least 75% of the market in terms of total revenue, then that continual adoption is going to make Ethereum deflationary. And that just removes that supply overhang from that protocol. Even though, Bitcoin runs at a inflation rate now of around 1.7, and after the next halving, that will be halved again. So it's almost negligible. But it does give Ethereum a slight edge, I think, going forward.
Yeah, in fact, I just threw up a slide there on the ETH burn of how deflationary it is right now. It's currently burning at a rate of about 1.2 million ETH a year. and the supply growth is minus 0.43%, which is pretty impressive. So again, it's changing very fast.
And that's really still in a very much an activity recession,
Yep,
right? So
exactly.
we're still going through a bear market, and activity is, it's down still about 40 or 50% from those highs.
Yeah, well, I agree with you wholeheartedly that even when you look at the volatility of ETH, it falls faster than Bitcoin, but also rises faster on the other side. So it's like a double-edged sword as you go forward. How does Bloomberg, you guys are kind of the lifeblood of data and information to kind of investors around the world across all spaces. And you guys clearly have vaulted yourselves into the cryptoverse, and your main priority is to advise institutional clients. But how do you differentiate yourself from others, or are you just completely unique in the space?
Well, Bloomberg Intelligence, it's the content that we provide for our institutional clients tends to be very very data driven. So the content that we write is not usually very long form content. We really speak to the visualizations, the charts, and the data that we use in our research. So usually we try to describe a story or describe the narrative through data or a chart, and then write very concise summaries of what that actually chart means. It's actually quite visually appealing, and it's bite-sized, and it's a little bit more punchy than the kind of research that you'll see from other institutions. And the other thing is that Bloomberg really differentiates itself from other institutions in the space because we don't really have the conflicts of interest that a lot of sell-side brokers and advisors do. So we don't have any advisory business, and we don't have an investment banking business. So there's no conflict on that side of things. We can write really unbiased research for our clients.
So you can't buy 10,000 puts on the S&P 500 and then go on CNBC and talk the market down. That many people do.
I mean, we still apply the same rules as all the brokers in terms of in terms of that stuff. But it just means that because we don't have those regulatory licenses, that we can't be as explicit as a broker would be with a buy, hold, sell recommendation.
Yeah, good. Let's get back to Bitcoin for a second. We talk about Bitcoin dominance. I know you've studied that a lot, and I'm very interested in your take. I believe the crypto world is very, very different to how it was in 2017 in terms of the players, the utility, the value props, the adoption, etc. A lot of people are still looking for 2017 like Bitcoin dominance numbers, and I am of the opinion this time is different. It's a very different market than it was 5 years ago. How do you look at Bitcoin dominance right now? People are expecting, with this recent kind of run, the 40% run, with that 10% pullback right now we're living through not because of TA or Wyckoff or anything else, but because of what Gary Gensler said. Everybody has to kind of understand that. What's your how do you view dominance today? And where do you expect it to go over the coming 6 to 12 months?
Look, I think the next 6 to 12 months, the L1s space and even the DApps will probably still underperform for a little while yet. I think Bitcoin dominance will maintain. I mean, it's obviously up against Ethereum, and Ethereum may start to eat into that Bitcoin dominance, but I still think that this year it's going to be volatile. The macro conditions are, this has some similarities to 2019, which we can get into, but I still think that because of the fact that we've never really seen a recession, that there still will be a lot of volatility, and I think Bitcoin will be favored over some of the more speculative plays.
Yeah, because when I look at some of the data, like with the altcoins, especially in the top 50, top 100, the returns have been astounding. We've seen names go up 900%, 200%, 300% is very, very common. And the actual returns for kind of leaders in the pack have been kind of stunning. Do you look at, I know Bloomberg's focus is primarily ETH and Bitcoin, but do you look at any L1s, or do you have any favorites out there?
Yeah, so I mean, first year in the role, I really wanted to just bed down the models for Bitcoin and Ethereum, and we've done a pretty good job of that. We have models which encompass like 40 or 50 different metrics for Bitcoin, and for Ethereum now it's sort of about 60 or 70. And that's taken a little while to develop, but now that they're in place, we can start rolling out models for other L1s as well. So we've started to look at them, but not anywhere nearly as intensely as those other two assets. I think in the L1s, I do believe that despite the fact that Ethereum has 75 to 80% of total fee revenue within the space, that there will be other L1s competing for market share. So I don't think that entire space is going away, but I do think that a lot of them will fall by the wayside. I mean, you can't sustain an industry with over 100 different chains. But each chain has their own specific use cases. They have their own technology and they have their own unique trade-offs. And that's going to lend themselves to different applications and different types of activity. So in that space, I think, I probably haven't done enough work to really come out with like a preferred L1. I think the L2s are looking very good on Ethereum. There's some issues there, but I think, the Solanas and the Avalanches, they're going to be in the mix. They're going to have, they're going to be there in a couple of years' time and in 10 years' time. But we really have to look at those fundamental metrics and see how they're performing, because that's what ultimately drives the performance of those assets. Number of transactions, the number of users, the TVL that they're gaining, and then how do those adoption metrics rate relative to the other L1s to make those relative comparisons, those relative investment decisions.
Music to my ears. It's like people will think we are reading from the same hymn book or whatever they say. But what about when I look at, say, L1 technology? I don't know how much you guys deep dive into the technology, but I see three generations. I see the old ones, the 5+ year old L1s, which will remain nameless, which includes ETH. Then you have the ones that were born in kind of 2018, 2019, 2020. And then you have the new breed, the Aptos, I can't remember the other one, those other guys that are coming in fast and furious. And many of them are kind of lookalike models for some of the 28 models. But do you look at the technology stacks in those three areas, and do the old technologies, because in any type of technology business, you have a concept called software bloat, or you're hindered by old technologies, old code, old methods. Do you think everything that is new will be better and will win, or will it be the middle stack?
Yeah, so I would regard myself not as a technology specialist. So I don't look as much into the inner mechanics of the consensus mechanisms, other than really to just make sure that I'm aware of where the major trade-offs are. So, I mean, Ethereum obviously has been pillared for the fact that it has been, the low throughput, and the actual roadmap for Ethereum has looked to address that, because its major, I guess the strongest point for Ethereum is its decentralization, is the security factor. And other chains have just made different trade-offs. They've gone with speed over security. Now, I think that just actually, that means that certain types of activity will gravitate to certain chains based on those different trade-offs. If you're a gaming application where your concern is not to be censored, then obviously throughput is all that really matters. So there will be chains where that trade-off is evident. There is centralization of validators. There's very high concentration of supply in the hands of a few, where that won't matter. But when it comes to financial transactions, when it comes to tokenization of real-world assets, that trade-off means different things to those players. So they will gravitate towards the chains that may be slower, that have taken a different path or a different trajectory, that do focus on the decentralization aspect of blockchains.
Yeah, I agree. There will be a chain for a different purpose all over the place. But things like, we'll see where it all goes. A lot of people are very excited about the gaming industry, but that is one area that I have no clue about. So we'll skip. So a lot of people are interested in, the current trend up until 30 hours ago was bullish. But when you zoom out, the dip is not that dramatic. And a lot of people want to try find the answer to this question, because a lot of people believe it. I think 70 to 80% of say that FinTwit is still very bearish. A lot of people talking about 12K, 10K Bitcoin. Do you think in 2023 the Bitcoin 2020 lows will be tested again?
I'm of the view that the 2022 low was the low for the cycle. But obviously, I'm prepared to be wrong. We are entering in a different era. Like, crypto's never had to go through a US recession. So, the cycles repeating themselves exactly as they played out in the past, whilst they do have elements and features which you can correlate back to. Every single cycle is slightly different, and now we've got a different macro environment. I think ultimately, if we do slide into recession, I think it's fairly likely in the US that the Fed will have to respond, and that's generally good for risk assets. And that's what I think the market is starting to forecast, right? So markets are forward-looking mechanisms. So they're looking at what the situation will be in 6 months' time, and they're of the view that the Fed will be cutting, and that's given a bid to all sort of risk assets. So you've got, I think that's basically the low for the cycle was 2022. It could potentially test it again, and it may even break lower. But the important point is that in 2022, we had the massive deleveraging of the cycle that was required to cleanse the system from all the excess. You had, you not only had leverage in that cycle, but you had a huge amount of rehypothecation. And that rehypothecation basically brought the market undone when rates started to rise or liquidity was being withdrawn. And suddenly you realize that everyone was naked at the beach. So that had a massive implication too, I think, for Bitcoin price. I mean, I think all that fake Bitcoin that was issued was actually a suppression of the Bitcoin price ultimately. You increase supply, the equilibrium price also falls. So, but unfortunately, that's also scarred a lot of people. So the cycle resets. Those sort of factors, when I look for bottoms, it's a combination of different things. It has to be, firstly, the price action and the sentiment at the time. It has to be sort of the macro picture also, because in those June, July lows, and we'll talk about the June, July lows first before we talk about the low that came later with SBF. But if you look at realized losses on chain as a percentage of market cap, you had the second highest reading. In the highest was actually the 2020 COVID collapse, where it fell 50% in really a day. Yeah. So that kind of capitulation low from a technical standpoint is really what you're looking for. And if you're a TA person, then you just look at volume on equities. But realized losses, so that's a wonderful thing about on-chain data. It gives you so much more granularity than what you can get with traditional asset classes. So we know the volume spiked, typical of a TA capitulation low, but we could see where the realized losses were for people who owned the asset, where they were dumping it. And that was the second highest reading. And when you get those kind of spikes, you know that you've flushed out a lot of the leverage people have thrown in the towel. And also at that time, we were at max bearish or max hawkish Fed at that point, right? They were way behind the curve on inflation, and they were forecasting 250 basis points of rises over the next sort of 1 year. So you had the sentiment, you had where the Fed was in terms of talking down the market, you had the perfect ingredients for a bottom. And then it retested because we found out there was more fraud in the system, and that fraud is still washing through. So even if we do break lower because the S&P goes down another 20% from here because earnings are coming off a cliff, clearly costs are starting to roll over, inflation's starting to roll over, but activity is also starting to really contract. But you're not going to, I don't think you're going to see anything like the carnage that you saw from last year, because a lot of that leverage was just, it was eviscerated.
Yeah. And I have a theory, just like we're getting diminishing returns on Bitcoin, I also believe there'll be diminishing levels of drawdowns, because the amount that's being hodled by long-term holders is growing all the time, and people are getting smart to kind of what Bitcoin is. If you imagine in 2022, there wasn't that set of cascading liquidations that lasted over 5 months. If that didn't exist, do you think we would have gone below 30,000? And the reason I mentioned 30,000, that's the price at which Tesla bought Bitcoin. It's also the price at which they sold 90% of Bitcoin. It was like their stop loss level. I thought it was kind of clever. And that's why I kind of anchor on 30,000. Have you ever thought about that?
No, I mean, I think it all came down to the tightening from the Fed. I mean, the macro cycle really drives crypto. It drives assets.
Stuff. I think you may have frozen there for a second.
Right, and especially long duration assets. So okay, sorry.
Okay, you're back. I hear you now perfectly. Good. Let's talk about getting back to.
Okay, you want me to?
Oh yeah, I think it. Yeah, try say that one more time. It may have gotten it, but I'm not sure if I got it. Testing 1, 2, 3. Jamie, can you hear me?
Okay. You've got two major forces at play when it comes.
I lost you again.
Hey, James, can you hear me?
Yep, got you back. Okay, perfect. I could. The picture gets fuzzy.
It's really bad. Sorry, I'll try and just answer that. Yeah, I'll try and answer that question quickly in case we get cut off again. But I think everything's driven by the macro as well. Like, there's really two main forces when I think about this asset class. It's the technological adoption of blockchain technology. It provides financial services at scale, and it provides other industries at scale. So that is this constant, relentless adoption. But that adoption goes through phases, and that phases seems to tie very closely into the macro cycle. So if we didn't have all the deleveraging and all the events of 2022, it probably wouldn't. It would have been because the Fed hadn't loosened so much, right? So that was a byproduct of the very, very loose monetary policy.
Oh, lost you completely right now. So we'll just wait a second for Jamie to come back. In the meantime, you have me. There he is. Hold on. Okay. You are back in the box. Sorry.
Not having much luck here, mate.
Yeah, but it cut off instantly. So you said you believe it's driven by the macro, by the Fed, by sentiment, etc. So
yeah.
Okay, then. Good. Okay, let's jump and talk about again the $100,000 target for 2024, 2025. This is the thing that really within Bitcoiners, they're fascinated by this number, and such a prestigious firm like Bloomberg coming out and kind of almost banging the table, banging the drum on this high level. And I know you've had your conversations with Mike going back and forth, but what adoption is required to get us to that 100K level? And do you believe in that 100K level by 2024, 2025, especially in light of how I believe this time is different? Because if you go back to, say, summer, May 2020, I'd say 70, 80% of people knew what a halving was. Now, everybody who is in Bitcoin knows what a halving is. And I also believe that people will start front running in preparation because we're literally 14 months away. So with that, tell us about the 100K, 2024, 2025.
Yeah, so that's Mike's forecast for Bitcoin. Look, I mean, I've done a little bit of modeling around where adoption needs to be in the next couple of years to reach that number. And one of the things that I use in my model is one of the major inputs is just the number of active addresses on the chain.
Metcalfe's.
So if you look, and look, I mean, a lot of the forecasting that you need to do on these assets needs to have a common sense approach. If you just draw regression lines from the start of since the asset was conceived or came on the scene, in the case of Bitcoin 2009, or if you run those regressions from 2010, 11, 12, then you get some pretty amazing forecast numbers. What I've done is I've really tried to be as conservative as possible and looked at what growth has been like really over the last 5 years, okay, over the space of the last cycle, because the last cycle was really the first, as you mentioned, the first cycle where you had some institutional involvement. Now, overall, the growth rate that we've seen in the last 5 years has been lower than what we saw in the first sort of 7 years of the asset's existence. But applying that growth rate going forward from sort of 2017, you get sort of active users well above 1 million users. At the moment, it's roughly around 800, 900,000. But you can forecast that obviously will rise to somewhere in the vicinity of 1 million to 1.2 million. And when you get those kinds of active users on the chain, then you start looking at prices that could really be in excess of 100,000 by 2025. So I think that that sort of target, if you'd like to call it that, based on adoption, based on the cycles, is still pretty conservative.
Yeah, and I agree. I've done a lot of Metcalfe modeling myself. In fact, I've been obsessed with that since probably 2019. And we should share some models as well down the line. We'll do that. So getting back to 2017 and market manipulation, this is a common question. There was a guy called, I don't know, John Griffin, I think it was. I think you know him, but he wrote a paper in 2017 about how Bitcoin is manipulated. And he just said, when Bitcoin fell to 15.5, 16K. What is your take on market manipulation? I know that Bloomberg has a huge commodity practice, and we all know gold is heavily manipulated, but are there analogs between gold and crypto? And what's your take on manipulation of this actual market? We know whales do play games, but does it have a big impact?
Okay, so I mean, maybe I'd preface by saying that I think all markets are manipulated to some degree. I mean, if you just consider that the central player and actor in all of our financial markets are central banks, then by definition, they're manipulated through their monetary policy.
Yep.
Now, in terms of Bitcoin, I haven't actually read that paper from John Griffin, but I know a little bit about it. The effect that Tether has now on the Bitcoin network is extremely small because most of Tether's activity has moved off onto Ethereum or Tron. But in terms of Bitcoin, is it manipulated today? There is still a lot of exchanges that deploy or have less than optimal rules and regulations around wash trading to inflate volumes. So there's probably still that going on. I mean, a lot of the data providers out there try to reduce or minimize the effect of wash trading by removing some of the exchange data from their total volume data and so forth. But in terms of like other forms of manipulation, we just saw 2022, and that told us that there was a lot of manipulation going on in the market by the way of issuing of fake Bitcoin, right? So there is, I mean, if there is regulation that's needed, it's certainly needed in the off-ramps and in the exchanges. Any kind of business that has a custody model should be separate from trading and various other parts of those businesses. They're very much in a crypto exchanges like a hybrid model of custody trading and proprietary trading, and all of those things should either be, well, they should be spun off, they should be separate, and that should be regulated. And that's what we have in place in traditional financial markets. That doesn't mean things can't go wrong. We had MF Global only 10 years ago basically do the same thing, rehypothecate and also trade on customer funds and then lose it all. So yeah, there is definitely problems with the market today, but I think that there will be regulations around centralized exchanges, and it's needed to really bring the institutions into the space. They want to be involved. There are institutions that were on the sidelines who needed clarity from, either through regulations or legislation in this case, and have really walked that back because of what's happened with FTX. So if we do get common sense, regulation for exchanges and intermediaries in general, then I think a lot of that manipulation should be mitigated. It can't be completely removed. Humans always find a way. But I mean, that is the case in any market. You mentioned gold. You could argue that a lot of the treasury market is controlled through the treasury participants and the central banks. And so there's a lot of manipulation going on in every financial market, in every asset class.
Good. I'm going to switch gears for a second, and I'm going to show one of your dashboards, and I would like you to walk us through it. So I look at options action, perps, etc. all the time, but I'd like you to explain to the audience what this means. In particular, options open interest and perp funding rate, and why you have created this dashboard.
Yeah, so I mean, I'll look at there's a very high correlation between price returns and the amount of open interest in derivatives markets. The derivatives market trading volume is larger than the spot. So it's just important to understand what's happening, whether it's in the futures or whether it's in the option space. And really that perp interest rate is one of the best risk measures in the marketplace, a real-time dynamic sentiment gauge for how institutions or participants are positioned. Okay, so I mean, if that perp interest rate is extremely high relative to its past, that most of the market is long, and vice versa. Yep. And when you get extreme readings, you get very good timing indicators. And this is just another great thing about crypto. You get data that you can't get in traditional markets. Traditional markets has something similar in positioning data that comes from the exchanges, but that comes weekly. This is dynamic intraday data that you can do to do a check on where people are positioned. And obviously, it's really it's most useful when you see extreme readings. Everything in between gives you a sense of where things, how people are positioned. But if it's moderate, it doesn't really give you something that you can trade on. But extremes in that interest rate definitely are. And in terms of the options open interest, it's fascinating that in the last 30 or 40 days, that options open interest on Bitcoin has doubled, more or less.
Exactly.
That looks a little bit overheated at the moment.
Exactly. In fact, this is the dashboard that I look at. I kind of look 1 to 2 months out. This is the expiry from March. And a couple of things just to call out here. The put-call ratio is 0.37, which is a bullish sign traditionally. And also some of the big bets that are placed up around kind of $32,000 Bitcoin is quite spectacular. And not that much has been placed on the bearish side like it was. If we looked at this same March expiry back in December, it was a very different picture. So I think the audience here as well needs to look at these charts very carefully, because they do tell you kind of where the institutions are placing their bets. Because we were talking about institutions, so I kind of segued into this particular topic here, because there are also a lot of institutions that don't play spot Bitcoin. They just play future products, correct?
Yeah. I mean, it's because it's a regulated market. So the options activity on the CME, the Chicago Mercantile Exchange, so that's a regulated exchange. That is the best way for institutions to play Bitcoin, because it's a product they understand. It's a regulated environment. It's reasonably liquid. So when you see the CME futures, the CME options moving or seeing large volume, you know that it's probably institutions that are getting involved.
Exactly. You won't have a retail investor buy 1,000 contracts or 5,000 contracts at one point. And you can see, again, like you mentioned, all this stuff is completely transparent. It's live 24/7. And that's what makes it kind of incredible. It's actually, I always sometimes think it's kind of nice when the stock markets are only open for 6.5 hours a day, because it would drive you bonkers if you have to look at them 24 hours a day. But now we're living in the crypto era where you have to watch it 24 hours a day, which is kind of strange. Okay, there's some people are always asking this question as well. A lot of people missed the train, missed the boat, whatever you want to call it. They were waiting for that $10,000 Bitcoin. There are still many people that are still waiting for that. What would you advise them, although you can't advise them? What encouragement would you give people that are sitting on cash and waiting for that magical $10,000 Bitcoin? Or at what level would you recommend a person or an institution with DCA, although you can't at this stage? I know I've got to catch that very carefully.
Yeah. Well, look, I mean,
in 2022, so we're going up from here despite the undulations and the pit stops.
Yeah, there'll be opportunities where there'll be some reasonable dips this year. I don't Yeah, arbitrary numbers is difficult. I think perhaps the best way to think about it is where are we in terms of if we look at this asset or this asset class on a risk spectrum, where are we on that spectrum? Are we in the lower quartile, lower quintile, bottom 20%, bottom 25%, somewhere in the middle, or towards, the top quintile? I would argue that we're actually, based on all the metrics that I follow, the valuation metrics, and the technicals and the macro, that we're still really in the bottom quintile or bottom quartile. So really, the risk spectrum, where we are on that risk spectrum, is heavily skewed towards higher prices over the long term. But that, of course, with the volatility of this asset class, can mean that it can do some pretty crazy things on the downside. So ultimately, the question that everyone really needs to think about when they look at this space is, what's the correct position size? The best fund managers, the best asset managers and traders always think about position size. So if the risk is heavily skewed over a longer time frame to higher prices and some potentially very high returns, but that volatility is extremely high, what's the percent of your overall wealth that you're prepared to invest that allows you to sleep at night and allows you to be comfortable and not have not get into arguments with your wife about or your husband about? So I think it's really a question of position size, but I do think that we're in an environment where, because of all the things that we've just mentioned, that risk is skewed to the upside over the next couple of years.
Yeah.
Or should I say, skewed to the upside. The risk is much more compressed.
Like one of the things that I spend a lot of time looking at on-chain data, but the actual supply is so few right now on exchanges. I mean, if BlackRock came in with $50 billion and could keep the current price at 22,000 or whatever, it would be gone. That's it. The supply is gone with one $50 billion transaction, which is peanuts compared to what they have in assets under management. And that's the other thing that is just fascinating to me, is how scarce and how hard this asset is. So you mentioned one thing that's kind of interesting regarding talking to your husband or a wife about how much should be allocated. What is a responsible allocation for a younger person who's new to the game? Somebody who, sometimes I look back, what would I do 30 years ago if I was young and getting started with Bitcoin? Did you ever think about allocations you'd recommend for the youth out there just to position themselves for a successful future over the next 20 years? I know it's impossible to look out that far, but assuming Bitcoin survives it, a small investment today could be life-changing.
Yeah, look, I can't really say what that right allocation is, but I will say it's definitely not zero. And if you're, again, if you put Bitcoin on a risk spectrum and you put yourself on a risk spectrum based on your age, where do you fall? Are you at the lower quartile or the upper quartile? And that should influence that position size of that allocation overall. But I think, for young people, really, I mean, I think even for people of my age, an allocation makes a lot of sense. But you've got to, that position size is the big question that every individual needs to answer for themselves.
Good. And the other thing that people, I think, are going to do, not only are they going to front run the halving, they're probably going to front run the drawdown after the fact. Do you ever think beyond the halving and where the price action could go? Hypothetically, if you went to 100,000, would it fall again 80% down to 20,000, or are the days of 20,000 gone forever? A lot of people have said recently that we may never see $20,000 Bitcoin again, even though it's only 22 right now. We're pretty close to that.
Yeah, well, Bitcoin's volatility, it's still a 70, 80 vol asset. So 20,000 could be by the end of this weekend. So the volatility of the asset ensures that, there's going to be a lot of movement around the mean. So the trajectory based on adoption is definitely up and to the right, but you're still going to have wild, swings. I do believe that your view of like lower drawdowns over time are likely, but you have an asset class which is still very much retail driven, and you don't have the fail-safe of central banks bailing out intermediaries in the space. Like no one came to save anyone last year when they lost funds on some of these exchanges or some of these through these intermediaries. So the volatility is always going to be very high. So again, it sounds trite, but I think it's just a case of position size. Not to be too worried about the levels necessarily. If you think this asset is going to gain more adoption over time, then it's really just a position size, and those times when you get large drawdowns are probably times to look at increasing allocations or whatnot.
Yeah, it's very interesting the way you mentioned it's still very early from the institutional side of things to jump onto Bitcoin. I thought when the Financial Accounting Standards Board, FAASB, changed the rule where they could mark the asset to market, I thought that would bring a flood of institutions depositing part of their cash into Bitcoin. That hasn't happened. So that took me by surprise. What's your take on that one?
Yeah, that I don't think that gets enough airtime, to be honest. But it's only just happened. So I think maybe October last year or November last year, if I'm not mistaken. So now the rules are in place, which don't penalize corporates for putting it on their balance sheet. So that's definitely a very positive development for Bitcoin, extremely, because that has been I've talked to corporates about this, and they can't swallow that that rule, that punitive rule that was in place. Now that's changed. That does open them up. However, you've still got the issue with dealing with intermediaries, safe intermediaries, looming regulations, uncertainty that's been created through some of the enforcement actions that we've just seen recently. And that's still keeping a lot of the corporates and the institutions on the sideline. We're also in a tightening environment. And in a tightening environment, long duration assets, technology, for example, crypto, underperforms. When the next cycle comes, when the Fed and central banks are forced to do something about the situation they've created, when they start the money printing again, which is almost inevitable, it's mathematically built into the system.
Sure is.
And you've got an accounting rule change, and perhaps potentially, hopefully, fingers crossed, that there's been some really constructive regulations around exchanges, and you've got Coinbase, which I think is a very legitimate actor in the space, and now several others wrapped in through proper regulations. We've got regulations coming through in Australia. Europe's done theirs. UK is about to bring in theirs. The whole environment will be much more conducive for institutions to come in. And once that debasement restarts, once they see that it is inevitable that central banks will need to print, will need to debase, then you've got the recipe for a large wave of institutional adoption.
Yeah, I remember Michael Saylor saying, even if an institution decides to allocate to Bitcoin, from the time they decide to the time they can do it is approximately 9 months. So maybe we'll see some institutional adoption in July 2023. So we look forward to that time. Let me see. In terms, since we're spending a lot of time talking about institutions, but it is so critical because retail can only push this asset class so far, although there are some very high net worth individuals that have big bags. Who do you see as the big institutional players, 3 years from now, like out to 2025? I know Fidelity is making big moves in this area, and they've been a player for the longest time. They had mining rigs 8-9 years ago, I think, as far as I recall. And with institutions, when they do come, typically they'll come fit and fast. I read a report, I think it was Morgan Stanley or JP Morgan, I can't remember, where they surveyed top institutional asset allocators. And they said, what do you think will be the biggest growth area for you guys, for your trading desks over the next year and out to 2024? And the highest growth was crypto assets. So how does that all play in? And also, what impact could that have on scarcity? Because literally, if a couple of institutions come in fit and fast and allocate 50 billion, supply is gone.
Yeah. Well, in 5 years' time, we've had 2 more halvings. So you've got the protocol scarcity kicking in, inbuilt into the system. And then, so that's the supply side of the situation. But obviously what really drives it is demand. It's they're interrelated. Without that deflation or the disinflation in the protocol, you wouldn't see the demand. But I agree that you've got a situation where you've got a real supply squeeze setting up in the years to come. And I think we'll actually see that supply squeeze start to play out by the end of this year, because the macro environment is probably turned by then.
Wow.
And we've seen a reset in asset prices, and at that point, things will look very different as we're coming into the halving as well. But in terms of the
before you go on, that's the most bullish thing I've heard from somebody in your position. Supply squeeze hitting late this year, because once that does hit, it's game theory time, and that means things can get very exponential very fast. So I want to double click into why the end of this year, because that is huge.
I think it's a timing thing. And also, you mentioned it, and you obviously track this, as do I. Long-term holders as a percentage of the overall supply are now like 72% at all-time highs. So what we've seen throughout the bear market is increased conviction from whoever they are, mainly retail, large and small, because if you look at the different cohorts, whether it's addresses holding 1 Bitcoin or less than 1 or 10 or 100, the only cohort that actually reduced was the second top cohort, which I forget the actual range. It's probably like, addresses that hold like 1,000 coins.
1,000, 10,000, yeah. They're the ones that sold.
Right. Yeah. And what are they? I mean, they're predominantly the exchanges, the intermediaries.
Yeah.
Right. They were selling Bitcoin to meet client demand because they'd issued fake Bitcoin. So they really knocked out the market. But everyone else pretty much, especially the small holders, the retail types, were accumulating. So they've been and they've also been taking their coins off exchanges. So you've got the exchanges, as you mentioned, is the supply is going down, but then you've got a liquid supply becoming, or the liquid supply cohort getting greater and greater as a total percentage of the outstanding supply. When you get to a point where you've got a turn in the macro and you've got the next halving, you've got a confluence of different factors. And so that's the reason why I wrote that note at the start of the year, talking about the potential for a supply squeeze at the end of 2023.
Yeah, and this if what we both kind of agree is theoretically possible, and this is the fascination of game theory of Bitcoin, what advice would you have for those people that are planning to sell at, say, 69K, when literally, if this stuff all triggers, the confluence of events that you mentioned hit together at the same time, you could see that magical 250K theoretically if there's so few Bitcoin there. And I also believe when people start looking and like new players that are coming in with big amounts to deploy, and they start looking on chain, like I remember as Michael Saylor told me, he said his biggest fear that kept him up at night for months was not being able to get some in the quantity that he wanted to buy. And that was just, for him, he had night terrors about that. So it's very real. But what would you advise people who are planning to sell at 50K or 90K or 67K, something like that? Do you think they would be selling too early? Or do you recommend they should have a layer out strategy to take profits as they go?
I mean, if you believe in the adoption wave that's happening and the trajectory continuing into the future, then really these are small gyrations on a long-term uptrend. So again, it comes down to the position size. If your position size is such that you can sleep pretty comfortably at night and think that you can wait for 2 to 3 years, then I think it's looking like these gyrations around the mean of the overall trend is just noise. So I wouldn't get too tied up on arbitrary levels if I was trading it, which I'm not. But if arbitrary levels are simply that, they're arbitrary. Looking for key resistance points using technical analysis is obviously a very good thing to do, because that's where supply usually sits. So these are levels that are troublesome for markets to get through. But what happens if it does break through? Then you might end up having to basically re-enter at a higher price. So it's just a question of whether you want the added volatility of trying to trade these levels, or whether you want to just find the right position size and allocate accordingly.
Yeah, and the reason I say that is because I've seen people, the analog for me is Tesla lately. People bought it $102, $106, and they said, wow, it's gone up 30% in 4 days. And then they sell a covered call at 130, and they get called out. So it's just one of those things. Like, you never go broke making profits, but it's a shame to leave a lot on the table. I had something similar happen to me with Meta as well. Huge return, short window of time, and then sold a call and just moved too fast and after hours. So interesting times out there. Let's think about more history, because you did mention TA. Now, a lot of people are looking back at history. They're obsessed with history. Maybe TA is actually, a question for you. Is TA a self-fulfilling prophecy? Do people trade around patterns, or do patterns generate themselves based on supply and demand?
Well, so yeah, I mean, so patterns are just a reflection of like the human behavior that, as much as we try, we can't avoid. We can't stop from seeing, like, to permeate through markets. Patterns set up that look very similar to the past, and that's human psychology playing out in aggregate through prices and price discovery. So TA does look at the past, but I think most TA technical analysts that are worth their salt apply very much a quantitative rigor to what they do. So looking at sort of trend indicators, whether it's moving average crossovers, linear regressions, and actually backtesting the signal that you're looking to apply, and finding if there's an edge there, is really as important as really just the visualization of a trend line or a certain pattern. But I'm a CMT. I'm a chartered market technician. I've been involved with the organization. It's the leading technical analysis accreditation globally, and through that study of the discipline of technical analysis, as much as you understand that technicals are just a reflection of psychology, but it does give you an edge as long as you apply discipline in the approach by backtesting the signals, finding where there's an edge, and also being disciplined with the risk, and that's the definable edge. And I use it in my research. So I've got 40 or 50 metrics just on Bitcoin that are fundamental based. We've talked about them: active addresses, all the adoption metrics. Then I look at the derivatives. I look at what's happening in terms of the mining and the hash rate, all those sorts of things. But I also have pricing models, and I look at moving average crossover systems. And when the actual asset becomes changes trend on a medium to long-term basis, it's really significant. I mean, and those systems, can actually outperform an asset like Bitcoin. They can provide lower risk-adjusted returns. You can basically cut out some of the drawdowns, but you only get to that place if you're really diligent and you follow a discipline that's been of a system. And the key word here is system, a system that you've applied and backtested, and you haven't overfit, and you haven't fallen into all the typical backtesting pitfalls that people fall into. And then you apply that, and that can be very, very useful.
Good stuff. So if you look back at, say, 2019, there was a run not unlike the one we had between November and Feb. And then there was, up until the halving, it was quiet. There was like an 80% drop off. And a lot of people are thinking that could happen again. But I think, no, I think it's very different in terms of the attributes of the market right now. Do you ever think there is an analog between 2019 and 2023 right now, in terms of the pre-halving dip and then the run about 4 months out? Because we did have that strange, peculiar catalyst, which is an anomaly, that was C19 hitting in March, tanking the market, and then it just shot up. So,
yeah, the COVID really changed the analog. It disrupted the pattern. But if you're referring to that run up in November, which kind of started in the first quarter and then petered out by about May, where it went from like 3 to 14,000. Yeah. So I just wrote a piece on Bitcoin at the start of this week, and one of the things that I'm a little bit concerned about, just on a short-term basis, is that the number of transactions and activity on chain haven't supported this run up as much as I would like. And one of the key metrics I look at is the MVT ratio, the network value. Yeah. So the transaction value on Bitcoin has been trending lower, right? So, and that's a symptom of like some of the big intermediaries like FTX completely disappearing, and perhaps the take up of from retail and the reduction in institutional demand. So transactions have sort of been falling off. And that's a very important metric for the value of the network. I mean, the amount of value flowing over the blockchain has a very big impact on the price. But you've seen active addresses start to really actually take up. So you know that the size of the player has reduced. So my inference is institutions, are much more quiet than where they were 2 years ago. So based on that NVT ratio, we're actually at the second highest reading. And when you get very high, usually means that the network is expensive relative to the value of the transactions on chain. But that's much more a short-term thing. We could get a scenario where we get a massive run up like we did in 2019, and that year is 4 years ago. So you've got the cycle. You've got that cycle repeating again. We've come out of a bear market almost pretty much exactly where we did in 2018-19. And then you've got the Fed potentially loosening. They were doing QT at the time, but they were starting to wind that down. And by sort of September, October, Powell actually printed money to save the repo market. And this time he may actually have to print again to save the economy.
You can't unwind the mortgage-backed securities either, which is another problem. Yeah.
So there are some similarities, but
double-clicking into the NVT score, one of the things I noticed is different this time around since a lot of the big manipulators are gone was I remember you used to watch, Bitcoin, say Friday night, some guy would jump in, drop 8,000, tank the market, and then buy it all back cheap. That type of wholesale manipulation isn't as common. Doesn't that influence the NVT score? Because that type of whale dumpage isn't happening as much?
Yeah, that's a really good point. I mean, the NVT is it's a one-dimensional sort of viewpoint. It just looks at transaction value relative to the market cap. But you have to use a combination of different metrics. So I mentioned like active entities and active addresses. So active entities are just a glass node metric that batches addresses together if they believe through their machine learning that these addresses are associated, they're the same from the same entity. So inter entity transfers are sort of excluded out. In both cases, though, both have actually been trending higher. So there has been more entities and more people joining the network. It's just that the value of the transactions are less than where they were. So combination of different things.
Excellent. Looking at I'm jumping all around the place here. You mentioned Nick Carter earlier. You follow him. You probably follow a couple of others too. But another bottom signal that I look for is when you got your perma bears flip bullish. Have you noticed any people you follow flip of late?
No, I mean, not any high profile types. I see on Twitter a lot of people that were, that were burnt in 2022 in altcoins because they fell a lot more than Bitcoin, which shouldn't be a surprise to anyone. But also, I think with Terra Luna, that implosion, it sort of scarred a lot of people, and a lot of just general people seem to be like getting the whole Bitcoin ethos, but understanding Bitcoin for the first time or looking at Bitcoin through a new set of eyes. But I haven't seen any high profile people that I follow, because I've got a lot of the people that I tend to follow are very much pro Bitcoin, or not, some Bitcoin maxis, but people that really get Bitcoin.
Yeah. Excellent. There was one other thing that I do want to mention, just escapes my mind right now, but let's talk about the elephant in the room. That's AI. Everybody's talking about AI, and I know we're going off the reservation a little bit, but are there any AI things that you follow that are crypto related or otherwise, or you just stick to your knitting, focus on Bitcoin and ETH right now?
Yeah, I've pretty much stayed in my lane. So, I mean, obviously it's huge. It's just another one of these pillars of technological advancement and adoption that I think are, going to be incredibly important. ChatGPT is a game changer. The proliferation of AI through all the different tools that we have access to now is a total game changer. and I haven't really looked at the stocks or the exposures, and I haven't really read too much in terms of like how it could interoperate with crypto yet. So,
And another kind of question, which is kind of interesting, is how the Ordinals have not only brought about much more adoption and traffic on the Bitcoin chain over the last couple of weeks, but they've also cluttered the chain a little bit. Have you been tracking the Ordinal activity, the Bitcoin NFTs, which I personally believe NFTs don't belong on Bitcoin. They belong elsewhere. What's your take on that?
Yeah, I've been following it from a distance. It feels like one of these battles which could be a little bit of a distraction from just looking at the numbers. But yeah, block space has been, consumption of block space has definitely gone up with their advancement. So, look, I don't necessarily have a view. I think, this is what makes this space so interesting and so intriguing. I mean, you've got a decentralized asset no one controls, and a total free market. And people's perceptions of what it could be used for are different from others. And therein lies the next probably ideological battle that Bitcoin has to face in terms of how its chain is used. I mean, what is Bitcoin there for? So I won't necessarily weigh into which one might be right or which one might be wrong, but it's fascinating to watch.
Exactly. It's good to see the purpose, but hopefully it'll wither away because, again, it doesn't belong on the chain, in my opinion. In terms of another El Salvador, we have the CAF, or Central African country. I can't remember, some tiny places. Do you believe the game theory for countries could develop over the coming years? Especially now when you see a lot of big countries like the Chinese hoarding gold, apparently. And there's also been rumbles of finding a digital currency to trade commodities like oil to get away from dollar hegemony. Do you believe we could see some change in that calculus?
Yeah, I think it's inevitable. So El Salvador, I find it so amusing that El Salvador, which has been so maligned in the press for its stance on Bitcoin, and was the stories that were popping up in 2022 that they would default on their outstanding debt obligations, which pretty much was what if anyone's talking about El Salvador, they're talking about two things. They were silly for adopting Bitcoin as legal tender, and also that it was it was definitely the road to economic ruin. The actual truth is that their GDP grew, I think, by around about 10%. 30%. And a lot of it's been through how much?
30% over the last year and a half, or since they implemented. Yeah, it's up huge. A lot of that is tourism, though, of course. Yeah. But a lot of industry has moved there too.
Right. So yeah, 30%. I didn't know it was that high. And it came through from tourism and people moving, bringing capital, bringing human capital, bringing also financial capital. And of course, they repaid their latest debt obligation, $800 million, which the press were covering that they wouldn't. The press coverage of the repayment, non-existent. So, I mean, I think it's fascinating. And, El Salvador hosted a bunch of central bankers and government ministers last year as well to talk about their strategy. So they're spreading the word through the smaller emerging frontier market economies, so that Central African country, is really inconsequential on a global scale, but it's the start of something where I think with this multipolar world that we're definitely moving into, I don't think it's now debatable. Even your hardline economists, mainstream economists, are having to sort of walk back their their points of view around this. That we definitely are, and you can see it for the things that you've mentioned, like the denomination of commodities in other currencies. But when you're a small country, what do? Do you go out and purchase gold? Or do you move to a monetary standard which not only acts as a reserve asset, but is the financial infrastructure to bank your citizens? Because the JP Morgans, the large banks, whether they're local domiciled ones or international, they are not going to bank those citizens. They've had 100 years to do so, and they have not, because the incentive is not there and the technological effort is too great. And now with Bitcoin, you have an asset which is extremely volatile, so hence position size, but over the long term can protect against debasement. And it's a financial layer, a banking system in a world where even in those countries, they have access to mobile phones, they have access to internet, and they can basically bank on this network and transact on this network, which is, really what we're talking about there is really the Lightning Network, which is amazing.
And it's not even just those countries. I live in the United States where there's tens of millions of people here who are unbanked. And that's why the repatriation use case is a massive use case for Bitcoin too. Couple more questions. I know I'm running real late, but this is so fascinating talking to you. I have this theory that CBDCs are coming fit, fast, and furious all around the world. And when you see some certain leaks of news, like the Bank of England saying they never want to have more than anybody's wallet hold more than some like £10,000 or £20,000. I can't remember the exact number. But that type of Orwellian control over somebody's wallet is very terrifying. Do you believe with the advent and adoption of central bank digital currencies, that will drive a huge amount of Bitcoin adoption, or will it be a nothing burger?
Yeah, I think the outcome is definitely adoption of blockchain technology and a choice between centralized fiat on a blockchain versus the anti-fiat solution, which is Bitcoin. And once people understand that this whole control grid that is being disguised as efficient banking by the central banks and by governments, and what it actually means for your future in terms of security and censorship and privacy, then Bitcoin becomes, in the eyes of a lot of people who have yet to realize what Bitcoin means, it will start to make a lot more sense.
Yep. Exactly. So you and I agree. So it goes back to what we started talking about, the choke point. Because literally, if government officials would hear what you just said, they'd say, we've got to kill this Bitcoin thing fast. It's a threat to our control over the plebs. All right, let's one second last question. ETH versus Bitcoin. I know we spoke about theoretical price action going to 100K by 2025. If that does happen, and of course ETH will outperform Bitcoin, how high have you modeled theoretically could Ethereum go? Like we've hit, I think 4,600 was the high in the last cycle, which is a 3x from where we are now, if it does hit that again.
So is that in terms of just in the next couple of years, or?
Yeah, like say, for example, out to 2024, 2025, Bitcoin's at 100K. Theoretically, if we relay what we did last cycle, like I remember, for me personally, my average Bitcoin price is like 9K. Average price for most of my Ethereum is about $90. But now, because I added more, it's about $200 a pop. But you see that, ETH did a 7x and Bitcoin just did about 2x, to this point in time after years and years. So the question is, maybe ETH will do a 3x while Bitcoin does a 2x. But if Bitcoin goes to 100K, that's a 5x from here, call it. That means ETH could do a 15x.
Yeah, so I mean, modeling Ethereum is a little bit harder because there's more inputs into what drives the value of the network, because it is obviously doing more things. It has different utility. It serves a different utility function than Bitcoin. So the modeling that I've done really is just this is being fleshed out. But if we were just apply the same logic, which is really looking at one of the key adoption metrics, which is just activity, then by 2025, based on the trajectory of the last 5 years of activity growth, and you do look at a price for Ethereum above 10,000. So in terms of the returns, it's more because the because of the adoption curve is steeper over the last 5 years. Now that should moderate over time. So the way I've sort of looked at it too is I've basically looked at the lower end of the regressions to come up with those forecasts. So these are not even at the mean. So they're, I would argue, conservative. But the element that Ethereum has that Bitcoin doesn't necessarily have, and Bitcoin has some advantages over Ethereum. Like it's not just all Ethereum is a much better blockchain. It has different trade-offs, and it has issues as well. Potentially censorship on the chain as well, which I think the roadmap will eventually address. but it's still an issue with OFAC compliance starting to see, you are starting to see censorship, which is slowing down transactions. Putting that aside, though, you've got the deflation aspect as well. So you've got this very pro-cyclical mechanism whereby more activity drives, lower issuance, negative issuance, i.e. deflation. And that I haven't really factored that into my model yet. So, that's sort of the work that I need to do. But obviously, in both instances, they look pretty good over the next couple of years.
Yeah, let me just pop something up for you right here. Let me see if you can see this. But this is the...
I can't see that.
Sorry?
I don't have the link for that.
Oh, is it? Oh, it should be showing on the video. At least the users should be able to see it. The people watching the video, but it shows the daily active users right now. It's got Bitcoin 668,000, which I think you said about 700,000 daily active users. Solana 434k, ETH 407k, Polygon 254k. So assuming your calculus, we need the usage of ETH to go up a lot to catch up with Bitcoin. But the question I think I have is, how is all the value shared of the Ethereum network between Ethereum and the layer 2s? And this is where I really get confused. And I haven't been able to crack the code on this, and it vexes me. I'm trying to say, okay, you've got Polygon, trades at 5% the market cap of ETH, and you got Optimus and Arbitrum and all these other things. There's like 10, 15 of them, so many. How does that network share value? Or do you see the layer 2s as discrete value adds on top of the ETH market cap? Because if you are talking about, say, okay, imagine we look at ETH and all the layer 2s as one platform, roll up all the market caps. It could be, say, 1.4, 1.5 times ETH market cap as we go forward. Then you're flipping Bitcoin pretty close, would you say? But have you grappled with how accretive the layer 2s are to the market cap of ETH, especially if Ethereum is just used as a settlement layer, not a transactional layer?
Yeah, so that question has been vexing me as well. I've done some work on it, and I mean, I've really only in the last month or so started to dig in and try to understand this to a point where I can start to come to some sort of conclusions about what the value accretion is. So I don't really have firm views, but the first, I think it's a mixture, and this is where it becomes a very, very complex process to try and understand it. In the first instance, you have cannibalization of the transactions and the activity on the base chain through L2s. What does that actually mean for Ethereum holders? Well, it probably means the fee generation. Well, not probably, it certainly does. It means fee generation on the base chain will be lower as L2s proliferate or as activity moves from the base chain to the L2s. What impact does that have on the asset price? Well, firstly, it lowers the staking return, right? Because the staking return is a function of fees. So modeling where sort of what activity will mean in terms of that staking return becomes a little bit more complex, because you've got to understand that relationship between L2 batch transactions and what that means for transactions on the base chain itself. If you get all this activity moving to L2s and they're essentially 1% cost versus an Ethereum, then they're a 99% reduction in fees for transacting on L2s. You have to sort of 100x the number of transactions, just using very rudimentary sort of math here. You have to 100x more or less the transactions in L2s to make up for the shortfall on the L1. Now, saying that, there are some transactions which will not move to L2s because L2s have different trade-offs. You are dealing with newer technology, higher smart contract risk, and also increased centralization of the validators or the validating process on the L2s. In some cases, essentially one counterparty.
Yeah, and longer finality as well for many of the L2s.
Right.
Very important. Yeah.
Optimism, zero knowledge proofs, when that sort of comes on board and that starts to pick up, may address the finality issue. But yeah, with optimistic roll-ups, you do have that issue today as well. So it's it's evolving so fast. But Ethereum will attract certain types of transactions that the decentralization and the security risk deserves. But as those L2 sort of proliferate, as hopefully they decentralize and become more robust, then some of that financial transaction might move to L2, but probably not in the short term. So you should be able to, we should still be able to see activity growth on the base chain in the next cycle, but L2s will cannibalize some of that activity, and it's not yet entirely clear how that actually impacts Ethereum's valuation. I mean, some people have probably done that modeling, but I haven't got to that conclusion just yet.
I've been looking for it, and I've been trying to crack the code myself and haven't been able. So hopefully, if somebody does have that answer, we'd love to see what it'll be, because that'll help people allocate between, say, ETH and L2s, etc. But speaking of that, modular versus monolithic, have you looked at those two different types of architectures? Like if modular, you look at ETH and all the layer twos, all these different building blocks to solve one common problem. Do you think that's overcomplicated, or would one monolithic structure handle a specific use case? For example, running a stock market, stock exchange. Have you thought much about that?
Yeah, I haven't really thought about, where some of the, what structures will suit some of the traditional world or traditional asset tokenization platforms. So Ethereum, I think, is still in pole position for a lot of the traditional assets because of the decentralization and the fact that sharding will introduce that level of, throughput or speed that it currently lacks on the base chain. So, it really does depend on the use case and how we're not at a point right now where we're going to see traditional assets move onto the blockchain, in the next 1 to 2 years, let's say. In that time, Ethereum will address some of the speed issues through sharding and some of the other protocol upgrades. But I think that Ethereum's in a better position than the other chains for traditional world or traditional asset tokenization. Yeah.
Like if I was buying a chunk of real estate on a chain, I'd want it to be done right and securely rather than anything else. So I hear you saying. Penultimate question before we go talk about one little fun question for the audience. And thank you so much for staying so long. I really appreciate it. A lot of people believe, well, you mentioned Fed will pivot and money printing, QE will continue. Already, if you look at all the funding for special events like wars and stuff, the money printing is happening, but it's in an obscure way. You can't really see it. And the deficits are going to be probably the order of $2 trillion in 2023, based on the increased debt servicing and all the lack of capital gains that come from retail investors that they're banking on for 2022, which aren't there, trust me. But a lot of people believe that when the Fed pivots, the market crashes. What's your take on that?
If you look back at the chart of the S&P and the Fed funds rate is pretty clear. When the Fed starts to cut, usually the economy is tanking, and earnings have come off a cliff. So you do have that dynamic at play, and I have sympathy for the views that the worst of the stock market, the price action on the stock market in equities or the S&P 500 is such that it's due for another leg lower. I think that is definitely possible if you look at that analog. But the markets have almost caught on to the Fed's game here, and they're starting to discount a lot more in the future, which has made the Fed much more steadfast in trying to bring inflation under control, because it's fighting the psychology of the market that it itself has created through its own policies over years and years and years. So you've got this real battle at play, and if the Fed really wants to push it, if they want to basically break the back of inflation by destroying the economy, then they will keep rates higher for longer or put in more hikes than what they should. And yes, that will completely crater the stock market, in my view, and we could get another leg lower. So we're looking at a real game of chicken at the moment between the market and what the Fed, is likely to do.
Yeah, it's funny because I think this is probably the single most anticipated recession ever in the history of the world. Everybody is kind of expecting the same thing. And when the whole world expects the same thing, sometimes it doesn't happen. So I'm beginning to come around to think that maybe there'll be a soft landing. I'm beginning to see companies, like say tech companies, they've been laying off early and hard and fast, trimming their budgets. And they'll still be able to grow because, disruption grows over time. So it'll be interesting to see how this plays out. I think for the first time ever, there might be a chance of a soft landing, which I thought was impossible if you asked me that 3 months ago. Anyway, final fun question. I'm going to zoom in on you for a second. Are you a musician? I see a guitar on the wall.
Sadly, I'm not a musician. I don't have a musical bone in my body, unfortunately, but I love music. So this is just an Eric Clapton piece of memorabilia that I bought at an auction many years ago.
Well, be careful. I hope you've got a good house alarm. It's like having a big coin on the wall or something. People come get it. But that's neat. Well, with that, I think this has been a fascinating conversation. I love the way you could bounce around and talk about so much different stuff. And there's a lot of stuff for us to circle back on too, like the accretive value of layer 2s on Ethereum. I'm now going to dig into that, and I'll kick you a couple of models that I have as well that might be of interest to you and your team. So big thank you. Happy weekend, Jamie. Sorry for burning an hour and a half of your time, but the audience and I really appreciate it. Remember, everybody follow Jamie on Twitter. He publishes some great stuff, including some of the slides I shared earlier too as well. With that, happy weekend. Thank you, Jamie. Be in touch soon. And thanks everybody for listening. Bye all.
Cheers.